If you're contemplating getting an IUL, you may be wondering about fees. What fees will you have to pay, and can the company change them at any point? And ultimately, how will those fees compare to traditional investments like 401ks or IRAs? Hey folks, I'm David McKnight, best-selling author of The Power of Zero. In today's video, I'm going to go through the fees of one of the leading IUL policies in the industry and show you exactly which expenses are guaranteed and which expenses could be changed. I'll also show you how those fees stack up against traditional investments over time. To illustrate how these fees work, I'm going to be showing you a policy on a 40-year-old male, best underwriting class, initial death benefit of $334,076, contributing $20,000 per year every year through age 65 and growing at 7% per year gross of fees. This policy is designed to have as little death benefit as is required by the IRS while contributing as much money as is allowed under IRS guidelines. In other words, this is a properly structured IUL designed to maximize the growth of cash value over time. Okay, let's go to the policy expense page of the illustration and tackle these expenses one by one. The first expense we see is the premium charge. As you can see, this expense is 8% per year from years 1 through 9 and 4% in years 10 plus. Per the contract of this policy, this expense schedule is guaranteed to never change. Next, let's take a look at the policy fee. This is $7.50 per month or $90 per year over the life of the policy. This expense is also guaranteed to never change. Okay, now the per unit charge. This is a per $1,000 charge and is based on age, gender, death benefit, and risk class. It's only applicable to the first 15 years of the policy on a guaranteed basis. So as you can see in the illustration, that expense disappears in the 16th year and is guaranteed to never return. Next, we have the cost of insurance. What you're paying for here is annual renewable term insurance. That means that as you get older, the cost of that insurance gets more expensive. You'll notice that in the early years, when the likelihood of you dying doesn't change much from year to year, the expenses stay relatively low. But then in the 16th year of the policy, this amount rises slightly and then goes up with each subsequent year as your mortality risk begins to rise. That's the nature of annual renewable term life insurance. As the risk of you dying increases, the cost of insuring that risk increases right along with it. Next, you'll notice a column for rider charges. I don't typically recommend any riders if your goal is to build tax-free wealth as efficiently as possible. So you'll notice there are no charges in this column. Lastly, you'll see a column for asset charges. This would only be applied to select index allocations where an index multiplier might be added to your policy. For example, for a 1% fee, you could add a 40% multiplier to your index return. So if you get a 10% return, they'll add another 4% on for a total of 14%. They would charge you that 1%, rain or shine. You'll notice that I haven't recommended that for this particular policy either. One expense you don't see here on the illustration, but which is critical to the success of your IUL, is the loan provision. This particular company guarantees that their loan provision will always be a net 0% cost. That means that loans from the policy can be taken on a tax-free and a cost-free basis. As I've said many times in past videos, this is one of the most important provisions in the entire contract. Even a net loan provision of 1 or 2% could really sink your IUL over the course of a 30-year retirement. Insist on having a contract with a guaranteed 0% loan. Okay, now that we've broken down the fees of this IUL and shown which ones are guaranteed, let me make a few observations. First of all, this particular company guarantees nearly every one of their fees. The only one that they don't guarantee is the cost of insurance. This may seem like a huge drawback, but it's actually standard protocol for cash value life insurance policies, regardless of the company. Life insurance carriers reserve the right to change that expense because it's contingent upon mortality rates of the general population. Should a pandemic wipe out a huge portion of the population, they'd reserve the right to increase that expense. This is their escape hatch should people across the general population begin to die at a much more accelerated rate. Okay, second observation, I encourage people to not fixate on policy expenses in the first 5, 10, or even 15 years. Why? Because these policies only make sense if you are planning to keep them for 30 to 50 years or longer. And if that's the case, you're better off looking at the average expenses per year over the life of the program. And the best way to describe these expenses is as follows. They're higher in the early years, much lower in the later years, but when you average them out over the life of the program, they will cost you well under 1% of your cash value per year. That's less than the typical expenses in a 401k. Let's look at this IUL illustration to see how those expenses can dramatically reduce over time. Take a look at the expenses as a percentage of your first year's contribution. This particular individual contributed $20,000 that first year and paid $3,502 in expenses. That means their first year expense ratio was 17.5%. Hardly a good deal, right? Well, now let's look at the expenses in the 25th year of the policy as a percentage of the cash value. The cash value is now $1,332,364, and the expenses are only $2,568. That represents about 0.2% of the cash value, dramatically lower than the cost of a competitive 401k plan. So, in summary, the costs of the IUL are much higher in the early years and much lower in the later years. And when averaged out over the life of the program, compare favorably with traditional investment accounts. Now, let's figure out the average annual cost of this particular IUL through age 65. To do that, we go to the internal rates of return page of the illustration. That tells us that the average internal rate of return by this point in the contract is 6.89%. If the gross illustrated rate is 7%, that means that the internal expenses on average per year over the life of the program are around 0.1%. In other words, so long as you're planning to keep the IUL your entire life, the cost of the program as an average percentage of your cash value per year is practically negligible. Now, you may be wondering, what's the likelihood that you'll actually experience a 7% internal rate of return? Well, rates of return in the IUL are a function of two things. First, expenses. And as I've demonstrated in this video, every single expense in this particular IUL is guaranteed not to change except for the cost of insurance. And that typically only changes if mortality rates across all demographics increase dramatically. The second variable is rate of return. If you recall, I ran the illustration at 7%, but what's the likelihood you can actually achieve that return? I'd say pretty good. If you look at the average rate of return of every IUL this company offered since 2006, they've averaged over 7%. So solid, sustained performance over a long period of time. In summary, if you're looking for an IUL, make sure that company can guarantee all the expenses except for the cost of insurance. If you give an insurance company 50 years to make up their mind on non-guaranteed expenses, then their fox is in your chicken coop, and eventually they will increase those expenses. And that means your cash value will lag, and you'll take much lower distributions in retirement. Lastly, when you look at the expenses of the IUL over the life of the program, you'll find that it compares quite favorably with traditional retirement accounts. What's more, you experience safe and productive growth and get a death benefit that doubles as long-term care. If you need some help finding an IUL that has guaranteed expenses, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power of Zero advisor, head over to powerofzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comments section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.